the basis of this webinar, I'll post in the chat in a little bit for those that haven't seen it, is a piece that you wrote, I think a few weeks ago about, what could happen if governments try to seize BTC on chain. And can you just share with us some of your key takeaways from the piece?
Yeah, so really it's a piece about the idea of decentralization and what does that mean? What's kind of the value proposition downstream from that? The short kind of summary of my hypothesis is that, a lot of the cryptocurrency blockchain projects really are rooted on this foundation of we're decentralized, and the value proposition of the coin or token or network is that there's this element of censorship resistance, which is a nice sounding term, but if you kind of dig deep into what that means, often it just ends up being a euphemism for the ability to operate outside of law. I would argue that, that's not really accurate of almost all blockchain networks. And so in this piece, I kind of explore the biggest one, BTC, to ask the question, like, is this really decentralized? What does that mean? And could the government actually interfere at this layer 1 level? And if it could, like, what would that mean for the investment? And then, that kind of ends up with our thesis of we're much more optimistic about projects that are leveraging the efficiency and scale of blockchain rather than decentralization.
Yeah, so, of course, we're more excited about that, but I think it's even more than that. It's not just that we're more excited about companies that explicitly aren't trying to leverage decentralized blockchains. It's also that we don't really think BTC is even decentralized. So can you talk a little bit more about why you don't think BTC is decentralized? As I think for most of the people on this call, they probably own some BTC, or the institution they work at owns some BTC, and that decentralization is a core part of that thesis.
Right. So there's this idea that BTC is very decentralized. There's thousands of nodes. Law enforcement, even if they had like the best intentions, they couldn't intervene because if they shut down node X, there's still node Y, node Z, and thousands of others downstream. That's an interesting idea, but if you look at the nodes that are actually producing blocks on the network, so you can just go to tons of websites track these stats, and I include one in the piece. Really, what you see is that there's this power law. So, like any open system, there's a handful of companies that do the vast majority of the block creation, and then there's a very long tail of nodes or miners that maybe mine 1 block, or the vast majority mine 0. So when you look at the network graph and the numbers that I pulled from when I wrote the piece a few weeks ago, 50% of the network is controlled by 3 companies. And these are big, kind of by definition, these are big companies, as to be able to mine so many blocks, you need to have a lot of infrastructure. So the idea that, the government can't shut down my node, thus the network is decentralized, doesn't mean so much if your node is irrelevant to the network. So the kind of whole basis for the piece was this tornado cash sanction. And you saw the government step in. Tornado cash was a mixer. The government stepped in and said, these addresses are being used for money laundering. We're going to sanction them. And immediately you saw a lot of these large companies comply with, not facilitating transactions. Those companies were all what I define the piece as layer 2 companies, the companies that don't maintain the blockchain themselves, but service it. So companies like Circle or Kraken, and they all complied immediately because that's their incentive to do so. So that caused kind of a lot of discussion in the space of what does that mean for the censorship resistance? I thought we were decentralized. So I'm really taking that one step further and talking about, the miners, the companies that layer 1 that actually maintain the blockchain itself. Would they have the same incentives as a Kraken? And if so, what does that mean?
Yeah, so you also make the claim kind of further that falls from this, that it's not just that BTC and most blockchains and crypto are not decentralized, they're also not censorship resistant. So can you speak a little bit more, you kind of addressed this in your last answer, but just kind of more on how BTC specifically and blockchains in general are not actually resistant to, government censorship?
Sure, yeah, so there's, it's really tied to this idea of decentralization. So if it's not true that my node matters and the government can stop my node, but they can't stop your node. And there is this Pareto distribution such that you have only a handful of companies. The government is able to serve like a court order to a company like Foundry USA, which is currently the largest miner on the network. So we see when law enforcement gets in touch with Circle or Kraken regarding Tornado Cash that they want to comply. They have large businesses, they're not going to jeopardize it, even if ideologically they're opposed to the idea that the government can sanction a protocol like Tornado Cash, which I think would be true for Kraken. They're like their leadership is relatively ideological. They're still going to comply because they want to protect their business. So my argument is that the same incentives would face a company like Foundry USA. So if the government goes to Foundry USA and says, hey, we identified these different UTXOs on the BTC network that were involved in this online drug market, which this isn't like a hypothetical. In the piece I kind of lay out an ongoing government action that involves a large drug market operating out of Russia. So they identify the coins, and they can say to the company, like, you have to reassign these coins. Like, we don't know who currently has possession of these keys. We've already frozen them at this like layer 2 level, but further we want to like seize these assets. We want to recover these funds. So they can go to a company like Foundry USA and say, all these assets or all these UTXOs that we identified as being proceeds of crime, you have to assign those from where they currently are to this other address that the DOJ owns. And so long as the government would do this in coordination with the majority of the network, that type of transaction would work. So I think a lot of people think like, this is impossible thanks to cryptography. You need the private key. That's true, for like the average user. I couldn't steal someone's funds this way. But if you have this like large coordinated effort kind of spearheaded by law enforcement, then this type of reassignment of funds is possible.
Yeah, and I just want to pause here because this is definitely a pretty contrarian position. I think there's very few people. I'm personally not aware of another fund that is focused on crypto and blockchain that has made this claim. Because I think a core part of what people think is valuable about crypto or blockchain is the ability for governments not to be able to do this. For a difference between, hey, we know this bank account's a terrorist or drug dealer bank account, and there being a different outcome than if we know this, crypto wallet is an Al-Qaeda wallet, a Chinese fentanyl dealer wallet. Ultimately, blockchain is much more transparent than the traditional banking system. So our ability to know what money is laundered and kind of whose accounts are whose is actually much greater blockchain today. And anyone here can kind of do a quick Google search to see kind of the known terrorist and drug dealer accounts. So really kind of the bet on a censorship resistant or decentralized blockchain working is a bet that, the strongest, most powerful governments around the world will allow that to proliferate rather than seizing funds as is common in any other type of way today. So more specifically, I mean, you kind of talked about how this would happen. What would the process look like to the miners directly? Like, how are they going to process this without the private keys?
Right. So this is where we get into uncharted waters. There's nothing that's making it technically impossible, which I think would be the claim from like many thought leaders in the space. It's not technically impossible, but it would be difficult and expensive, especially for the first one. So I think like you would need a very large carrot to incentivize this type of thing, and recovering $5 billion of assets from an online Russian drug market, I think, very well could be that carrot. Yeah, so what does it look like? So what the miners need, what their incentive is to like stay in consensus. So the easiest way to stay in consensus is you just reflect reality. So you look at all the transactions, you make sure that they're all valid, you put them into a block, put it across the network, other ones check it, they're all valid, they agree, and the blockchain, you keep adding these blocks. So the easiest way to stay in consensus is just to be honest and reflect reality. So, that's kind of like core to Bitcoin's design. I'm not going to throw in a fake transaction where I pay myself extra Bitcoin because the other miners will be incentivized to reject that. And it's not in my interest. So typically, this is happening just with, you take the private key with the public key. If that outputs to true, then it works. So in the instance of the government, not having the private key, but wanting to reassign the funds, you just need to get this majority of miners to agree simultaneously that, even though we don't have the input and the output, for this transaction to compute to true, we all have to agree that like this is a valid transaction. So you would need something like, a coordinated effort from law enforcement to kind of get that coordination. So what does it look like? We'll have to wait and see, but I think it's something as simple as the government, gets in touch with these miners. So Foundry USA, Amp Pool, F2 Pool, Finance Pool, Poolin, 4 or 5 companies. And the directive is basically like at this block height, 700,000, whatever the block height is, take all these transactions. We're going to form them into all these UTXOs, form them into one transaction that goes to this address. There's no private key, but if they all have that and they all agree that that's true, whoever mines that block, everyone else will see it. They'll say, yeah, this was like coordinated ahead of time. We agree that this is true. And the end result will be that the coins will be moved. This will obviously be like public to everyone that's looking at the blockchain. So like, it's no mystery that this didn't have a private key. But you'll have, kind of the normal process, like documents from the DOJ, like, all the legal steps will also be there as well. So there will need to be some type of software to make that simple for the pool operators. That software I know is already in development from the Bitcoin Association. So I think it, for them, it'd be like a relatively simple process. And then you would just like the key thing again is just having law enforcement to coordinate it so that it happens at this like simultaneous instant.
Yeah. So in that vein, Mark asked a question here, which is if a government order to move coins is enforced against 6 nodes, it wouldn't be nodes, it would be miners or mining pool operators. So against, let's say the 6, I mean, you basically named them, Dave, there's the 5 or 6 biggest, mining pools that control the vast majority of network traffic. You put 85%, Dave. I think in actuality, it's much higher than 85% in terms of the top 5 or 6 mining pools, right?
The top, what was it? The top 6 was 84%.
Okay. So you're pulling it from our piece, more judicious than myself. And they complied, but the remaining, mining pools, miners don't comply, other nodes don't comply. What happens in that scenario?
Yeah, so this is the common response. If you look at like the responses to our tweet of this article when we posted it, it was a lot of thought leaders in the space saying like, that's ridiculous. All of the hash. It's like what a mining pool is a bunch of people that own machines that hash. They'll like provide it to this company that then does the job of creating the block and taking the hash. So, the hash is giving its resource to some pool. So the common critique is like, well, that's crazy. If Foundry USA did this, all the hash would leave and go to another pool. So like why that doesn't convince me at all is that if you take this small pool, this like very ideological anarchist pool, they're not going to comply with the government. And a bunch of these like anarchist hashers that are using Foundry currently are like, screw this, we're going to go move to anarchist pool. Well, now anarchist pool is like a huge company. So like you haven't changed the network topography at all. You just have this like new leader. And what's that new leader's incentive? Is it to, not comply and risk their business? Or is it to comply, anger some ideological users, but keep their business running? So I think like that doesn't make a big difference. What you would see though, so like let's say that the anarchist pool is small, but they disagree. They say like this is not a valid transaction. Basically, they just make their own little fork. So now you would have like BTC, and then a piece I call this like RBTC, resistance BTC. So BTC is the one with the majority of the hash that complied with court orders, and RBTC decided that that was a line too far and rejected it. Well, then the question is like, what support does RBTC have? So does Coinbase list RBTC? Does Kraken list RBTC? Does your Trezor wallet have an interface for RBTC? I would think like the incentive is the same for all these companies. So they're probably going to want to stay compliant. So that's the case. Now you have this like side project, which, doesn't have support from these large companies. The market price is probably very suppressed. And then what did you win is the question. So, I think that almost certainly would happen, but I think it would be kind of like a thing that was relatively irrelevant pretty quickly thereafter.
Yeah, we're talking about something that would almost certainly be, sanctioned and really just used like explicitly for money laundering and criminal activity.
Yeah, because the whole like its existence would be with the goal of evading international law enforcement. So like the whole reason for it to be there is to be, you know, in violation of law. So I can't see that being a very successful thing long term.
Yeah, nor can I, and nor do I imagine most of the people on this call. And I think the disconnect is, you know, that is a core, that is different than the core value proposition as presented today by BTC. Whether or not, you know, by owning BTC, you want to facilitate money laundering, you want to facilitate kind of resisting governments, that is the reason, a big part of the reason that people are holding it. And I think this piece doesn't argue that, hey, like Bitcoin doesn't have any value. I mean, on the contrary, at Unbounded, you know, we're in many ways some of the biggest Bitcoin bulls on Bitcoin that's just actually trying to scale versus on the BTC version. Our thinking is just that when this kind of inevitable collapse of the illusion on BTC being censorship resistant happens, then likely a lot of the market cap will go away. Because if you can't kind of use BTC in violation of what governments want, then really what is the value of this asset?
The other thing that I would add is that the process I'm describing is something that makes sense for an asset forfeiture of $5 billion of drug money. It doesn't make sense for like the high school kid that bought some weed, right? So I don't think it's a future surveillance network where the government is like undoing all of these transactions. That just like the cost benefit there doesn't make sense. I think this is a tool for, you know, very large types of seizures. And it's the same thing for Web 2 technology. So like doing some coordinated international effort for small crime just doesn't make sense. But if it's a huge crime, then countries are, you know, are willing to go through the effort.
Yeah, I think it's important to note for those of you who it's not clear yet, we would not welcome the surveillance state of governments kind of looking at the details of every transaction and having ability to press on or off. It's more that I think we think it as a good thing and certainly inevitable that if large scale crimes and money laundering are being done, being able to, you know, use the law and the government's monopoly on, you know, kind of violence to convince these miners, to force these miners to change it, that's happening whether we like it or not. And we would argue it's actually like a good thing and we should embrace that, and that the rule of law has been a great thing for the development of civilization. Which
and even
I don't think, yeah.
Even getting to the point, so like this Hydra, this Russian drug market action, even getting to the point where they are today, you know, prior to any type of reassigning of funds, it's really expensive, right? Like, it's not like you look at the BTC network and you see an address called like drug market. So they had to do all this old-fashioned police work to like figure out, you know, they had to like send undercover agents to buy drugs. Okay, now we know that this address is part of it. They build out this whole like graph of all these transactions. So this is like old-fashioned police work, like following the trail to create this case. And then, you know, Bitcoin's design is inherently private. So like right off the bat, whatever you're doing is not like visible to the world. But if you're doing something illegal, it's, you know, it's a evidence trail that you can follow if you're sufficiently motivated.
Just want to address one of the comments here, which was that Mason wrote, the RBTC would not be a fork. The chain which won't comply will die unless they change the protocol with a hard fork. We're using fork in kind of the cultural way, not like the technical way. For those of you familiar, technically doing a fork is like, you know, having a minor enforced change of the protocol rules. But for example, the fork that resulted in kind of the difference between BTC and BCH or Bitcoin Cash, and that kind of BCH version of Bitcoin continuing to scale and BTC stop scaling and cap the size of the block at 1 megabyte, that actually didn't result from a technical hard fork. That was what's called a soft fork, where basically a bunch of nodes, not necessarily a majority of the miners or hash power, but a majority of the people running nodes kind of changed the rules. And so the kind of the most consequential, you know, fork, so to speak, in Bitcoin was a soft fork and not a technically a hard fork. So whether it's hard fork or soft fork, and there's a change in the protocol rules, which we don't think will actually be likely, we just think that, you know, the funds will be reassigned, kind of this will happen. And almost certainly there'll be kind of a contingent of anarchist, you know, Bitcoin people, because that's really the whole like reason why Bitcoin stopped scaling today and why the popular version of Bitcoin can't do anything of value. It's because they were preparing for a scenario like this, where governments are trying to reassign funds or do something, and they're like, hey, we need to make sure the blockchain is slow and inefficient enough such that we can run the node software on our phones and laptops so we can more easily illegally resist those government actions. Because if Bitcoin kept scaling, well, then you'd have kind of the inevitable economies of scale, and you'd have the problems that we're talking about now with staying censorship resistant, because the majority of hash power will be real businesses that can't hide. You can hide with an anonymous laptop or phone. You can't hide, 300 megawatt facility. So, yeah, we think there'll definitely be this kind of anarchist fork, but it'll effectively be very inconsequential. And given there's blockchains that are much, much better at kind of laundering money and staying hidden versus being a public database with every single transaction easily accessible for anyone in the world to see for free, likely a lot of those kind of folks that initially are excited about anarchist BTC will kind of just move over to the Moneros or maybe something else that emerges, as we've kind of already seen today, which, during the Silk Road era, there was a Monero then, but, BTC was the dominant way of using cryptocurrency to launder money to buy drugs online. Now that's shifted because people realize that, Bitcoin is whatever version of Bitcoin you use is a terrible, terrible way of laundering money or doing illicit things.
I think just to kind of punctuate that, I think that really is the key thing, is that BTC has put all of their eggs in the censorship resistance basket. So while what we're describing, this is true for Bitcoin SV also, we're not deriving all of our value from this can't be confiscated. There's major BTC conferences, at least there was a few years ago, I'm not sure if they're ongoing, but the name of the conference is called Unconfiscatable, right? So this is they're very explicit that this is the value proposition. I think they kind of temper that a little bit as they're trying to get investment from more conservative type investors, institutions. But at core, it's really about this, this thing can't be seized. So I think what's so devastating is if that's revealed just to totally be false, then what do they have left?
Yeah. So since you wrote that piece, I'm going to paste an article here or a web link from the UK government. We saw some news come out of the UK. Dave, can you share your thoughts on that and just update the audience for what happened?
Yeah, it was very timely. I didn't have advance notice on this. But yeah, 2 weeks after the piece, the UK introduces a law. Kind of explicitly, they say the goal, we're gonna look at how to seize, freeze, and recover crypto assets. It's not about crypto assets exclusively, but they are explicitly going to update their proceeds of crime legislation from the early 2000s to incorporate how to seize, freeze, and recover crypto assets, which are increasingly being used for criminal activity. So I think it still remains to be seen what that will look like, but I think it's just further evidence that this is the direction that we're going. It's a tool that I think most law enforcement doesn't know that they have at their disposal currently, but once it happens once, then okay, now we know that this is something that we can do, and I think that changes everything. So like I said, I think it'll be more, the first time will be the most expensive time. They have to figure out how to do it. They have to do it successfully, but then there's a precedent, and I think that that will have a very large impact on the crypto and blockchain industry. So when that law materializes and when we actually see this happen, it's hard to say. I would be surprised if within the next 3 to 5 years, if we don't see this type of action. That would be very surprising to me. It could be much sooner. I think it really depends on the educational hurdle for law enforcement to know that this is a tool at their disposal.
Yeah. And last kind of development since the initial piece is your new piece that you published earlier this week. We were not expecting this action or to have this piece kind of when we initially planned the webinar. But Dave, if you could just share the takeaways from the piece I just posted in the chat, which is your piece on unlimited liability and DAOs and the potentially huge precedent that was just set last week.
Yeah, so last week, the CFTC filed a complaint against, I think it's called OOKI, OOKI, OOKI DAO. basically letting them know that, hey, even though you guys are, quote unquote decentralized, you have to still comply with law, which should be a relatively obvious statement, but I think is, a heretical statement in the blockchain cryptocurrency space. What was really interesting about the action is that, so this was a company from two founders. They had an LLC and they operated this company, and they were looking around and seeing a lot of their peers having legal issues or getting served. And they were like, hey, well, we're in this decentralized industry. Why don't we just decentralize? And then when the time comes where the government's knocking on our door, well, they won't be, because there's no door to knock on. We're decentralized. So that was their plan. They moved from the centralized protocol to this DAO, this decentralized autonomous organization. And what the CFTC complaint said was basically, if you move to a decentralized DAO, you're not immune from law enforcement. And really now the business operators are all the token holders who are voting on governance. So typical structure in DAO is you have this token and you use the token to vote on what the DAO does. And the CFTC basically said, those people are operating the business. So, they're part of the defendant class. So it's the CFTC versus Oki DAO, an unincorporated association. And the unincorporated association is the two founders, because they voted in protocol changes, as well as all the token holders who voted in protocol changes. So this is really just the absolute worst case scenario for DAOs as a tool to evade law enforcement. The CFTC couldn't have been more clear that, like, hey, this just isn't the case. Decentralization doesn't mean immunity from law. And now if you voted in these protocol changes, you're now liable for these monetary damages, which are pretty small, but I think the precedent is pretty enormous.
Yeah. Okay. Well, that was kind of the end of, yeah. Sorry.
I'll add one thing there, actually. So the reason it's called unlimited liability, it's a very short piece, if you want to read it, but basically, if you're a member of this unincorporated association, you don't have the protection, unless, you held your tokens in an LLC, which I'm guessing most didn't, you don't have the protections of limited liability. So not only is it worse for these token holders because now they're part of this defendant class, but imagine this was $250 million penalties. Now, like, people are going bankrupt. So the simple point that I make is, like, you kind of created this like Rube Goldberg machine, which like didn't even work. And you would have been much better just going with the tried and true method we have to limit liability, which protects you much better than decentralization. Just wanted to add that.
Well, thank you, Dave. And thank you everyone for listening. I guess we did just about 30 minutes on the dot, or I guess we started a couple minutes late. So about another 30 minutes now for additional audience questions. So feel free to write it in the chat, DM, or, turn your mute off and camera on and ask it in front of everyone. Thank you so much for listening to the short interview today.
Hey guys, thanks always for your thoughts on crypto and Bitcoin. Curious on a slightly different topic from today's presentation, what the latest is on Tether and when you think that one's going to unwind.
Yeah, so Tether has been something that us, for years have been saying, and again, this is not like what we've talked about today, where we're kind of been alone on an island and, slowly people are starting to join. This has been not consensus in crypto, but somewhat consensus in the broader financial world that, Tether is likely to blow up at some point in some capacity. It's really just a question of when and how much. And, I think guesses on how many dollars they actually have compared to the dollars they say they have, that would be really, really hard to know right now, and constantly changes given how much exposure they have to such risky speculative assets, not just in crypto. We saw they had huge exposure to Evergrande or whatever that big Chinese real estate blowup was. Like, they had tons of commercial paper there. But the short of it is that, Tether has admitted and said to the government, there have been times where we said we had $1 for every dollar we had, and we've had, as little as like 30 cents, or I think it was 29 cents. So this is like a statement from Tether. They've never agreed to do an audit. They've hired and fired all sorts of auditors over the years. And fundamentally, they run their business as you give us $1 and then we run this dollar in our own kind of proprietary, insane, hedge fund thing where we apparently buy lots of commercial paper and are the largest commercial paper buyer in the world. And not a single dealer of commercial paper has ever gone on record saying they've done a single trade with Tether. So that's kind of all you really need to know. I think the ability to have an edge in predicting that, there were times, especially in our first fund when it was a hybrid venture hedge fund, when we're like, when's a good time to short Tether? Like, how do we monetize this thesis? And there was definitely a time when I think the risk reward on doing that was much more attractive. But now there's like entire hedge funds started by Wall Street shorting veterans that like are specifically about making money on this. The funding rates have gone up a lot. So I think kind of that the alpha in Tether shorting it specifically is gone. I think though that, and we have, so most of our LPs today are hedge fund managers and the family offices of, current and former hedge fund managers. That's, I think, typically who finds resonance with our thesis more than maybe more traditional venture capital LPs. So as a result, a lot of them ask us for stuff like this, not so much as part of, okay, how do I short Tether, but more like, how do I make money off this as it affects and ripples potentially through the broader financial system? And our two of our, not our two biggest LPs, but the LPs that have the biggest AUMs have been the most active in terms of like asking us questions on this. And even them with like, significant resources and experience in being able to do that, in short, haven't found ways to make money off kind of, what we think about Tether and kind of looking at the financial engineering. I think they're well positioned for something were to happen. Maybe they could. But those are, I think, kind of like the relevant thoughts in terms of how to monetize this thesis, how it affects the rest of the portfolio. But yeah, if you're listening to this and aren't of the understanding that Tether is extremely likely to blow up and is a very shady organization that has violated all sorts of financial laws and regulations, you don't have to look too far to find that.
In terms of recent developments on that, so last week or the week before, there was news that Tether was ordered to produce documents showing backing as part of, I think it's a class action lawsuit.
Yeah.
And then the other thing is that, they're making deals with a lot of these companies, or they were making deals with a lot of these crypto lending platforms that have since gone bankrupt. So I think, in the bankruptcy proceedings, we may learn more about those relationships also. So yeah, there's nothing that's come out recently that's like new information from my point of view, but I think it's likely we'll see that in the relatively near future, given all these kind of legal actions.
Yeah. Thank you, guys.
Thanks, Nathaniel. So we have another question here from Mark Overly. Do you have a view on the percentage split of DAOs in terms of their reason for existence between censorship resistance and democratizing governance? So this is a good question, and ultimately, I don't have a comprehensive view of this. Getting like when looking at all the AUM of DAOs and figuring that out, that would be a hard, perhaps kind of impossible problem. But I can tell you anecdotally from what I see in terms of Twitter and friends of mine. Most of my friends are kind of in consensus crypto land and talk about DAOs and have founded DAOs and are invested in DAOs. I think it's primarily about democratizing governance. That's the language that they use. That being said, crypto people are very good about lying to themselves. I think the primary reason people are in crypto today is because being early to BTC and Ethereum made you more money than any other possible, investment in the history of the world, basically. So people have told themselves what they need to think to feel good about kind of chasing those returns. So I think with DAOs, people are really excited and will like tell themselves, I like it because of democratizing governance. But I think a big reason they like it is that, the convenience of not having to abide by securities law, I think would be like the actual reason why this happens. And I don't want to call this person out, but there's, a friend of mine who I respect who kind of started a DAO. And I like pushed him on like, why are you doing this via DAO? You have like an actually great real business here. You're not trying to pull a grift. And then, as the conversation developed, it kind of, just became clear that a big reason was, kind of democratizing ownership, which i.e., evading securities laws because we don't like them and we want everyone to be able to own a token. And, I actually own a lot of the token and I'm able to like get liquidity for the token very soon. So it's, if you have a really strong financial interest in, this way of democratizing governance, being the future, well, then you'll convince yourself that that is the thing.
You can also like, there's the above board DAO process, which is like go to Wyoming and do the DAO thing. So like, that's like kind of this, I'm not an expert on that, but that's like, if you're going for the democratizing governance approach, that's a way to do it. But I think a lot of these crypto people, and if you read the CFTC complaint against the Oki DAO guys, like they're just drinking their own Kool-Aid on the decentralization thing. So they're like if you have that mindset, why bother with this like confusing legal thing in Wyoming? You're decentralized, like you're fine. You don't need to worry about it. What are they going to do when they're mad at you for evading AML KYC and marketing that you're doing that? That's like your edge. They can't do anything because you're decentralized. So I think there's just this naivete with most of the space. So like they might opt not to go that route, but yeah, I'm not sure what the breakdown is either, but it's an interesting question for sure.
I'll jump in, Zach.
Hey.
So totally shifting gears, but we seem to see a lot more funds related to NFTs in a variety of different flavors. I guess I'd just be curious of your thoughts on the segment in general, all the way from the art spectrum to the utility spectrum.
Yeah, so thanks, Creighton. I would say that, talking about NFTs, like a lot of things in crypto and blockchain, is so tough because the delta between like the buzzword and what happens and the technology is just so vast. So what does NFT stand for? Non-fungible token or non-fungible technology, which is basically saying that like we know that this data is correct. So in that sense, like every blockchain focused fund is an NFT fund, and every important piece of data we think will be an NFT or have a hash of that data on an NFT over the next decade or 15 years. That's what we're betting on. In terms of NFT being like, overpriced art membership scam, that's how it's like generally used. And yeah, I think when you look at like a fund that would market themselves as an NFT fund, I can't think of a fund I'd want to stay away from more than something like that. So I definitely I've seen a lot of those funds. I think I saw them more near the height of like the crypto, technology stock bubble rather than right now. I think it's just a really tough sell to be like, hey, here's a piece of art that if there's a physical one, you very rarely own the rights to the physical art. You barely have rights to do anything with it besides just say that it's yours. And most of the time, that data for the NFT is actually stored on just like a normal AWS server, and they're just pointing the link of that AWS server on the blockchain. It's not actually even on the blockchain itself. So in terms of like a financial asset with such a delta between kind of underlying value, fundamental value, utility, and price, I think NFT is kind of at the top of the leaderboard for that. So I'm not really involved with like looking at those things so much. I hear about them kind of peripherally, but I would not really expect so much proliferation of, things like that. But, we've definitely been wrong in the sense that like we've identified things that we think have very little fundamental value and seen them and their prices and interest from investors skyrocket for a number of years. Although I think we've definitely seen kind of a reckoning on most of those things that maybe we identified in 2019 that took off, that are now at, I think more so than not lower prices than where they were for 2019. But, if you traded it right, you were able to make a lot of money along the way.
I can connect why. Let me connect why NFTs have been so underwhelming with the topic of the initial discussion. So most NFTs that you saw were, these like very high priced art pieces that were sold for like exorbitant sums of money. So like, why is that? And like, why weren't they doing other interesting things like Zach was describing with all these like use cases for data that's unique on chain? I think it's largely informed by limitations of the transaction fees. So if it costs $100 to actually like get the NFT sent to you, you're gonna have to sell it for much more than $100, right? Especially if it's worth $200,000, then the $100 transaction fee is pretty insignificant. So like, why are there $100 transaction fees? It's because of this inefficiency that basically all blockchain networks have that's hampering them. Why are they so inefficient? Because they're so decentralization obsessed that they can't have the economies of scale, which lead to efficiency, because then you have, these like Pareto distributions and you're not censorship resistant. So those are actually kind of connected topics, which is interesting. I think Zach's right. We'll see, if they're called NFTs or if they're not called NFTs, like that idea of these unique digital goods that exist on a public ledger, but are very, very efficient. So then you're not limited to just the speculative art use case. I think we'll see a ton of that. And maybe people won't think of it as like the NFT renaissance, but that's like what it will be really at its core.
Thanks, Creighton.
Thank you.
Zach, can I ask a question?
Yeah, let's hear it, David.
Or something of a comment. So I always go back to Carlota Perez and his technological revolutions in financial capital. And yeah, there's various stages that have to do with technology, innovation in finance. But so always talks about, I think, the turning point has to do with the balance between individual and social interests within capitalism. It's the swing of the pendulum from the extreme individualism of frenzy to giving greater attention to collective well-being, usually through regulatory intervention of the state and the active participation of other forms of civil society. So, as I hear Dave talk about the, the kind of the government initiatives to basically, stop money laundering and other types of crime, it feels to me like we're kind of hitting towards that inflection point where government intervenes, which ultimately enables the proliferation of the technology and the innovation. So I guess I don't see it as a bad thing. I see it as really kind of a positive step in the development of blockchain.
Yeah. So I thank you for sharing that, David. I really, really like this book. I first became aware of it when reading Fred Wilson's blog, of VC. He's really, really big on this book and this framework when evaluating startups, and obviously has had, some of the highest returns in venture capital history. So I think it's definitely, worth examining the book, even if their portfolio has a lot of crypto grifts today. But I was gonna just push back on, I think this, like, and let me just, whoops, my mic mouse just kind of broke a little bit. But I'm going to share the graph for those of you that are not familiar with Carlota Perez. Hang on one moment here. Share the screen. Okay. Can everyone see this here?
Yeah.
So you kind of have these different phases. And the assumption of this working is that there is actually an innovation and technical revolution happening here. So I think with blockchain technology, that is true, but I think we've barely started really with phase one. When you look at what has taken off, it hasn't been blockchain really being used. It's, crypto largely as a conduit for glorified Ponzi schemes, is what I would argue. So I wouldn't say that the proliferation of BTC, Ethereum, DAOs and DeFi things built on Ethereum is really relevant as here's the actual life cycle of a technological revolution. I think the technological revolution has started. We wouldn't be doing what we're doing on Unbounded if we didn't think that. But I think we're much more kind of in the, 1/3 to 1/2 through phase one, rather than kind of in those later phases with this government intervention. We have just barely begun to scratch the surface of what blockchain technology can do. And, using blockchain in an extremely limited and constrained way to, evade laws and regulations, and to, whether they're securities laws or, other things from CFTC, FATF, and other kind of global government agencies, that to me is not, indicative of what blockchain can do. And I think that over time, we're going to continue to be proven right in that companies that are leveraging scalable blockchains to accomplish big things and solve real problems in the world, that will vastly outweigh in terms of financial returns for early investors into that, as well as just in global impact in non-financial terms compared to what we've seen today with crypto and being early to tokens and companies that make money off the tokens.
Cool. Thanks for the perspectives.
we're in this weird position because we agree that this is like a very transformative technology, but we think everyone's using it wrong, which like puts us, it's a very tough messaging position to be in. Yeah, it's almost like someone invented like a car and they just like parked it in their living room and use it as a couch. And they're like, wow, cars are awesome. And we're like, yeah, cars are awesome, but like use it to like go from point A to point B really fast. That's the use case. And like they have this idea that like not only are cars not useful for that, but they're like really bad at that. Like they can't get you from point A to point B because they're stuck in my living room or something. I'm making up this analogy in the fly.
That's good. That's good. I'm gonna steal that, Dave.
But yeah, so I think we will see that life cycle for sure, but we have to first like reorient, like have a better goal. You got the wrong goal, which is really what this piece was about, is like, hey, your goal is wrong. Like you not, even if that was like a good goal, like you failed at it. So like, what is the goal? We think that we have like a very strong answer to that. But it's just kind of, it's going to take some time, I think. And this is already happening with a lot of companies that we've invested in. It's just like showing really what it can do when used properly.
Yeah, thanks for that, Dave. Thanks for the question, David. Anyone else? Any questions here? One last call. Does anyone here have any questions or comments on anything before we wrap up the webinar?
Good. Thanks, guys.
Hey, Zach.
Yeah.
I was wondering, can you comment just on the way unbounded portfolio companies use blockchains in ways that maybe aren't decentralized?
Yeah, so I think it makes sense to first define decentralization, which is, can be very different in terms of how it's used technically versus how it's used colloquially when talking about blockchain. So the way we've used decentralization today is effectively as this like new euphemism for evading governments, laws, and regulations. But if by decentralization, you're kind of talking about the distribution of power of data that blockchain can enable, then all of our portfolio companies are leveraging decentralization in a very serious way. So just want to kind of be clear with our terms here before moving forward. So none of our portfolio companies, part of their value proposition is, the laws will change or we'll be able to resist the laws, or other companies and users and people will be able to resist laws and regulations. That's not a part of the value proposition of any of our companies. But in terms of how they're kind of leveraging distributed data and actually, decentralized networks in the technical sense. I think one good example is a company called DXS, and I'll share this in the chat. So this is a company that allows you to invest or trade in increments as low as 1 cent. So right now, if you're kind of like a micro trader, micro investor, let's say you make, $5 that you want to invest every month. There's no product besides DXS that will allow you to invest that money into US equities or synthetic exposure to US equities. You can't really make those, long-term investments or get exposure there. But by leveraging, a scalable and an efficient blockchain, they're able to have a high gross margin and offer people the ability to make trades or investments in increments as low as 1 cent. And every single trade is published on chain, and kind of it's all verifiably, fair and honest. A rug pull in the traditional sense is not possible. So I bring up DXS because in many ways they kind of have like a product that looks somewhat similar to these censorship resistant DeFi networks and exchanges, but they're actually compliant and don't have this kind of magic box thing where they have their own token and you put your money in and somehow you get a yield from it. You can invest in DXS's liquidity pool, which is you're kind of taking a bet against these traders and investors making money over the long run. And, as they, lose money, you get a percentage of it. And if on any day they make money, you lose a little bit of your money, and they offer a yield that way and are able to have a pretty large pool as a counterparty. As so DXS is not actually taking any risk themselves in terms of providing this protocol and this company and this application. So I think that that's a good example of how a portfolio company of ours is using decentralization in the good ways, but not in the colloquial ways. Dave, maybe if you want to talk about another portfolio company of ours, given you kind of wrote these pieces that were at the core of our theme today.
Yeah, did you have a portfolio company in mind, or just generally speaking? Yeah, I mean, I think, like Zach said, like a network or a service being distributed, there's a lot of benefits there. The example I always use is like AWS is a very distributed network. If one region goes down, the website that's using AWS can just connect to a different region, but it's still Amazon's, it's still a company, and it has the benefits of that also. So I think this is like useful for kind of any company that's building a Bitcoin SV. And it also, like, because of the design of how Bitcoin SV works, it's very efficient. So like Handcash is a great example of a company that's doing payments over Bitcoin SV, making it very easy to integrate those payments into applications, kind of opening up a whole new world of applications that leverage different business models that just weren't possible before, and doing it via a very simple SDK. And Handcash's ability to serve that to B2B or B2C customers is really predicated on this distributed network of Bitcoin SV being very efficient and very robust, and up 99.99999% uptime and all these things, which come from its distribution. But again, yeah, kind of differentiating that from decentralization in the sense of we have a get out of jail free card, I think is very important.
Thank you.
Okay, well, I think that's a good, and one last call. Any questions for anyone? Okay, well, thank you so much, everyone, for joining today. Really appreciate it as always. We'll probably do another webinar, I imagine, in 3 to 4 weeks. As always, any suggestions on topics would be greatly appreciated, and looking forward to having you on the next one. Okay, have a great rest of your day.